Will the K-shaped economy sink the stock market? Well, today we're going to talk about what the K-shaped economy is, why I think it's going to affect the stock market in the coming years, and why I think that's happening sooner than you think. My name is Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management, and this is the Smart Money, Dumb Money Show. And you're smart money. I want to start off dedicating this video to my brother Gary. Gary, his partner, and I were traveling across Washington State a few weeks ago doing a wine tour because I like wine, and we got talking about the K-shaped economy. And I was inspired to deliver to you guys a little bit of some ideas on why I think the K-shaped economy is going to change the stock market. So we're going to talk today about 3 reasons why we have a K-shaped economy. We are going to discuss what the K-shaped economy means, for those of you who don't know, and how it will change wealth distribution eventually, and how it will impact the stock market. And I think it's coming sooner than you may think, as I said in the opening. So let's get started first discussing what the K-shaped economy is. You know, sometimes I look online to find a simplistic way of describing some of my points, and I found this image on the Google search, and I thought this is just exactly what I want to show you guys, and that is how the K-shaped economy really looks. And that is that there's 2 parts of our K-shaped economy. Some people or some sectors in the stock market or whatever it is we're talking about are doing well, and some people or some sectors of the market are not doing so well. That's known as a K-shaped economy because it kind of looks like the letter K. In this case, we're going to talk about wealth distribution in the United States and in Canada. By the way, the statistics I'm going to talk about mostly come out of the US, but they're 100% applicable to Canada. They're almost identical. So what we want to look at is wealth distribution. And the reason we want to look at that is because over time, that is going to influence government policy, and government policy is going to influence the market. So let's take a look at what it is, and then we're going to talk about how we got here. Okay, so let's discuss how the K-shaped economy is applicable to wealth distribution in the US. And as I said, it's applicable to Canada just as readily. So this is a graph that it can fool you a little bit because it's not the percentage of the population. This is the percentage of wealth. So if we look at this green section here, 13.6% of the entire wealth in the United States, and again, similar in Canada, belongs to the top 1.1%. So think of it. 0.1% of the population have 13.6% of the wealth. The next biggest allotment of wealth in the United States and Canada belong to that remainder of the top 1%. So 0.9% control 16.8%. So already we have about 30% of the wealth being controlled by 1% of the population. The final portion of the wealth, which is 36%, is held by the top 9% after that first 1% that we just discussed. So if we take these 3 components of total wealth distribution, it adds up to 67% of wealth is controlled by 10% of the US and Canadian populations. Now, to further illustrate how wealth distribution is becoming ever more concentrated, we're looking at this graph. That this is only going back to 2010. And by the way, I'm going to show you this graph later on in the video. But basically, it has been moving towards more and more concentration of wealth in that smaller percentage of the population. But it really escalated after COVID. And you guys probably know why. There was a lot of money printing at that time, and the money printing went into the hands of people who in turn invested in assets like housing and the stock market, etc., at a greater scale than it had been happening in the past. So now we're going to talk about 3 reasons why the K-shaped economy has become rather extreme in recent years. And reason number one is partially my fault. I'm a baby boomer. Baby boomers are people between the ages of 60 to 80. And it was a population boom. Now you think of it, people born in the 1940s, which is the oldest end of the baby boomers. I'm not in that end of the curve. Those individuals were born in the mid to late 40s, and they advanced their careers and became, just like most of us, capable of buying assets like houses and investments and their RSPs and all that kind of thing by about 30. So that brings us to the 1970s to 80s and on. And you can see on this chart here, this is 1980. After the 1970s era of flat markets, the baby boomers began investing in real estate and the stock market, and that huge chunk of population were buying stocks. And that started the great stock market from 1980 effectively until 2000. There's other reasons behind this, but this is one of the influencing effects on where the wealth came from and why the boomers control so much wealth. Because quite frankly, we were there, especially the very early boomers. I'm at the younger end of it, but a lot of the boomers were there to buy the cheap houses at $20,000 in the stock market. This is the Dow Jones when it was trading around 1,000, and now it's around 46,000. So this is what the earlier boomers were able to take advantage of that others have not been able to. So when we look at the three main generations that are controlling wealth right now, we have the boomers, 60 to 80 years old. We have Gen X, which is 45 to 60 years old. And then millennials, 30 to 40. And then the others, which are younger than millennials or older than boomers, and they're kind of the tails right now because they don't control a lot of wealth at either of those two extremes. Well, you'll notice that the baby boomers are vastly ahead of the next wealth group, which is the Gen X people. It's literally more than double. The Gen X controls about 20% of the wealth, and baby boomers are controlling about 55% of the wealth. So big extremes. And of course, the millennials, who are picking up, but nowhere near what the boomers have. So all of that influence by the large population of boomers that were buying stocks, properties, all that sort of stuff during the 1980s and 90s created a big wealth gap by itself. But now let's go on to reason number two, why the K-shaped economy has gotten so extreme in recent years. Okay, reason number two, why the K-shaped economy has been growing so extreme. And that is from monetary policy. And that is rates, which were fairly high during the 1970s to fight inflation, came down right at the time when the baby boomers were beginning to buy stocks and real estate and other such goods. You can see that the 3-month treasury bills peaked in about 1981 and fell over the next roughly 30 years until 2010 considerably. So again, lower rates, more accommodative rates allowed people to buy goods on debt and on credit. It stimulated the economy. It stimulated corporations to profit and hire people. It stimulated buying of goods. It stimulated the stock market. So that's one of the other factors why wealth grew so much during the 80s and 90s and on. We've been in a fairly low interest rate environment since around 2010, but it was a big boom of change in direction for rates during the 80s and 90s in particular. The third reason why the K-shaped economy has become so extreme is because of a change in government policies towards fiscal spending. If you know what fiscal spending means, is that when economies are weak, governments will often print money, stimulate, borrow to invest in helping the economy move. That changed in the 1990s as governments embodied the idea that's called modern monetary theory. And that is that it doesn't matter if we're in crisis or not, we can still spend lots of money and keep this economy growing. So MMT basically means that you can spend as a government. You're different than an individual household. You can spend as much and you can print as much money as you want. And it doesn't matter because the government can never default. It can print whatever it wants to pay for whatever it feels it needs. And debt is not a concern because it can be paid back by more money printing. And if the government feels that inflation is getting too high because of all this spending, they can control that inflation through taxation. So before I get into some of the fantasies behind modern monetary theory, as we found out in the recent 10 years or so, I just want to explain that one of the reasons behind the baby boomers and others' assets and capital and wealth growth has been because of this abundance of money supply in the economy. There's more money chasing the same goods. Well, that means the prices go up. That means that companies can buy more stuff, invest in more things. It means individuals have more money, so they put it into assets like houses and they put it into the stock market. Well, as the stimulation continues, then those prices go up because you've got more money chasing the same goods. Money becomes less valuable through money supply. So let's talk about some of the fantasy behind modern monetary theory and why, as we found out over the past 10 years, it has not worked so well. So let's start off with the idea of taxation, which leads into the issue of the government's printing money. So taxation is the collection of funds from the population to fund imperatives like military, law and order, your courts, your police service, that kind of thing, infrastructure, your public services such as education and healthcare. These are all important things. That's why we started being taxed to begin with, to pay for all that stuff that from a common good perspective, we're able to take advantage of. Expenditures that go beyond that collected by taxation can be abused by self-serving governments. And we've actually seen that. And I'm sure many of you watching this video can name quite a few examples. So the governments, with spending more than they're taking in, have an obligation, an ethical obligation to spend that money in a realistic way, to deploy the capital in a proper way, and not just to buy votes, for example. So if the government is going to spend any money beyond the basic needs of infrastructure and police and all that kind of stuff that I just discussed, you need some accurate data with accurate analysis of that data interpreted by qualified and unbiased, keyword, experts. The issue behind modern monetary theory, as we found out over the past 10 years, is that governments were printing money to buy votes and to do things that they thought would make them popular with specific special interest groups. And the expenditures were not used for analytically good investments. Good examples here in Canada, for example, here in Ontario, where I'm residing, government invested in several electric vehicle plants. Well, there was no analysis there because the market was already falling for EVs. Well, of course they closed down, at least temporarily, if not permanently. Here in Ontario, there was a famous one, cricket farms. The Ontario government actually invested in cricket farms, our tax dollars, which is ridiculous. And we actually printed money because we don't have enough tax dollars to pay for cricket farms. Well, the plant folded within a year or so of opening. It was a huge amount of money. ArriveScan, multiple corporate bailouts by the federal governments, things like gender studies. I saw that one come up as an expenditure by the government. These are not data analytically derived expenditures that will help the economy. These are just spending to buy the votes of special interest groups in many cases, or idealistic spending. So we need to make sure that if we're going to embrace modern monetary theory, in other words, spend away as you wish, that we still have some controls on that. I wrote a blog that I'm going to suggest that if you're interested in the subject of modern monetary theory, you take a look. But let's carry on. So because of the attitude towards spend as you wish by governments over the past couple of decades or so, we saw US debt and Canadian debt grow exponentially. Debt to GDP, all that sort of thing, increased rapidly because of modern monetary theory. Again, the idea that governments can print as much money as they want. And that debt is not contained to the US. In fact, Canada is the most in-debt country in the developed world on a debt to GDP basis. In fact, the recent Ottawa budget was called by the parliamentary budget officer himself. The independent parliamentary budget officer called the recent budget unsustainable. So this is still going on. Modern monetary theory is still going on. Spend away. It adds money to the economy. It increases the value of goods, but those who don't have a house or a stock portfolio are not benefiting from that excess capital that's chasing the same goods and driving those prices up. So we've just talked about some recent factors. We talked about the baby boomers. We talked about, monetary policy, meaning rates, declining interest rates. And we talked about fiscal spending and how that all created a price inflation movement which benefited the individuals who had capital to begin with. And that's really important for you guys to understand, that those factors helped the rich get richer and the poor get poorer. If you've already got investments in the stock market, if you've already got a house and the government's printing money and interest rates are falling, you've got your wealth increasing. But if you don't own that capital already, you're not taking advantage of the train ride. So let's take another look at how the K economy was set up to begin with. So in the 1970s, and by the way, we're going to talk about history in a few minutes prior to 1970s, how this happened. But in the 1970s, corporate profitability was low and inflation was high. So the government lowered the top corporate tax rate from a peak of 52%, 51.8 I think it was, in the mid to late 1960s to 34% by the 1980s. What happened? A stock boom. Adding to corporate profitability being stimulated by the government in the early 80s came the boomer population who were buying into those corporations at that point as their careers reached a point where they could start saving and investing and buying a house and all of that stuff. Stock boom. Next thing, you add in falling interest rates over time, which always stimulates the economy. Boom. Stocks went up. So you add in to the stock market boom that was created by falling corporate tax rates, by the baby boomer pressure buying those corporations, and falling yields, ever inspiring both investment, purchasing, and buying stocks, to the fiscal stimulation, the modern monetary theory that came into effect most predominantly after the 2001 stock crash. And you've got a major stock market boom, and you can see that. Here's the 1970s. We've got stage one, corporate taxes going lower. Stage two, the baby boomers enter into the market. Stage three, falling yields. And finally, stage four, after the 2001 stock market correction, or I should say crash, you've got modern monetary theory being introduced by governments. So all those factors, falling corporate rates, falling interest rates, rising money stimulation programs through fiscal spending, and you've got the largest portion of population that at that point had been seen in modern history, boomers, buying houses and stocks, and you saw a stock market boom. Well, the boomers, myself included in that, we were taking advantage of that through investing, buying houses and that kind of thing. And of course, many boomers were totally unconcerned about debt and deficits because they were riding the gravy train and it's all good. So the question is, after this big boom on the stock market and the inequality of wealth distribution in the economy, Deutsche Bank is asking, well, as the next generations buy these houses, buy these stocks, what will their prices be? It's a question. I've got some thoughts on that. Well, what is the solution to this massive disparity in wealth in North America and in much of the other developed world? Well, the solution could be to raise corporate taxes, and I'm going to give you a little bit of history on that potential in a second. But let's talk about where corporate taxes used to be, what happened, and how it has in the past been used to control wealth distribution. So in 1909, and prior to that, the corporate tax rate was 1%, effectively zero. So the top corporate tax rate, there was no tiers in revenue. It was just, here's your tax rate. Okay, it was 1%. By 1932, because of wealth inequality that happened over that area, some of you might be aware that in the late 20s, there were people making a lot of money and people making not so much money. So the corporate rates were driven up to 13.8%. Now, compared to today, that's not very high, but you got to think of it. If corporations were used to paying 1% tax and suddenly they're paying basically 14% tax, that's a big difference. So this affected their profitability, which in turn affected employment. So unemployment went up as corporations said, well, we can't afford to pay all these taxes, so they began laying people off. So it led into eventually, amongst other factors, it's not the only factor, by the way, I'm fully aware of this because there was definitely a bubble in stock valuations, but it led into, it was one of the factors that led into a peak on the stock market in 1929 and an eventual crash. More importantly, and how this impacts us today, is not only was there a stock market crash in 1929, but there was a very, very long period of volatility, as we'll be taking a look at a little bit later, in the stock market, leading well into the 1950s before we entered into another bull market, and that's important. The reason why I am going to consider that there's a possibility that the US and Canadian governments could start raising corporate taxes is because it didn't help the stock market much. It didn't even help the economy that much, but what it did do is change the inequality of wealth distribution, and we'll take a look at that next. So let's take a look at what happened during the 1920s to change that equality. Well, as I said, corporate taxes went up. Well, this is a chart right here, and the light blue line is the amount of wealth owned by the 0.1% of the population, the top 0.1% of families controlling the wealth. And you can see that in the early 1920s, as that stock market boom was taking off, that 0.1, this is 1/10 of 1% of the population, began controlling more than the rest of the population in the US. And so when in 1929 and on, the government began taxing corporations steadily higher to eventually get to around that 13-14% range, the stock market fell and capital assets fell, and the 0.1%, that top less than 1% of families controlling the wealth, began to fall. And of course, just by default, the rest of the population became more equalitized as far as wealth distribution. Let's go back to the 1980s, and you can see in 1980, we had the boomers, we had the falling corporate taxes, we had the falling interest rates, and eventually by 2000 or so, we had stimulation through modern monetary theory. All of this stuff started adding to the net wealth accumulation by that top 0.1%. And of course, the general population's percentage of the wealth held declined during the same period. Now this chart only brings us to 2010. Okay, so let's extrapolate that trend of wealth being controlled by the small portion of the population. And you can see during the 2000s, as fiscal stimulation began kicking in as well, it just kept getting larger and larger, the discrepancy between the wealthy and the poor. And then along came 2020, a lot of assets were purchased, as you guys know, right after COVID, and the stock market took off. A lot of the tech stocks really met their glory as people were forced to stay inside and use more technology. And those who held those assets, again, became even more wealthy exponentially speaking, including the tech titans. So going back to that period in the 1920s when the US government began increasing corporate taxes to help with the dispersion of wealth to create a greater point of equality, we had a stock market crash and an economic collapse, but that equality was equalized. Well, we have members of certain political parties that right now are wanting to do the same thing. This guy, Bernie Sanders, recently said he wants to have a World War II style tax on 95% of corporate windfall profits. So in other words, he wants to tax the upper end of corporate taxes. We saw that that actually is a very effective tool, at least it was in the 20s, to control wealth dispersion. In other words, the K-shaped economy. But it also ended up being pretty ugly for the economy and the stock market. So going back to the 1920s, that strategy of raising corporate taxes was effective in controlling the wealth dispersion, the K-shaped economy. And so we have individuals like Bernie Sanders in the US, the NDP here in Canada, that want to increase taxes on corporations and on wealth. And that definitely can change the wealth dispersion. But as we saw, it can change the wealth dispersion through stock markets and housing prices. So all of this that I've talked about, just to bring us right to a conclusion, is just me thinking out loud about what could happen based on one historical example. So all of this that I'm talking about is not necessarily going to happen, but it's food for thought because we do hear a lot of rumbling these days about the K-shaped economy, about the wealth dispersion. Some people don't know it's called the K-shaped economy, but it's wealth distribution. And if we go back to the 1929 example, we know we had a stock market sell-off, but more importantly, there was a period of relatively flat returns before corporations began seeing profitability as rates became lower. After that period of volatility, in the 15 or so years after 1929, we saw corporate rates continue to climb and eventually peak in the mid-1960s at around 52%. Well, thereafter, the economy slowed down and the government began lowering corporate tax rates again, so that by 1980, corporate tax rates were down to 34%, which is quite a drop from 52% in the mid-60s. So this, again, combined with the baby boomers and all that, created a boom. My question right now is, if we go into the same situation where the government begins to raise corporate tax rates, as happened from the late 20s and on right through into the mid-60s, will this create a volatile stock market with the potential for a major market crash or period of massive volatility over the coming years? It's a question, not a statement, but history does tend to repeat. So thanks for watching. We'll be back next week with a shorter video. I wanted to present this video today because I think it's worth your understanding, and I hope you were able to bear through it. And I want you to keep this in mind as a potential for the future as we move forward in our stock market investing. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.